Brent crude hit $110 a barrel on Friday, up 50% since the Iran war began, pushing rate hike odds to 50% and sending the S&P 500 to 4-month lows. The VIX climbed to 25.46, its 87.6th percentile over the trailing year, as WTI crossed $97, a level not seen since oil's peak in the prior cycle. Iran's South Pars gas field took a direct strike, and Kuwait confirmed fires at 2 refineries following drone attacks, narrowing the gap between disruption and outright supply collapse. The bond market is no longer a safe harbor. In a single month, the 2-year Treasury yield surged 54 basis points, the largest move since February 2023, when the Fed was at the peak of its most aggressive tightening cycle in 4 decades. On Thursday alone, the 2-year jumped 12 basis points to 3.92%, while the 10-year reached 4.38%, its highest since July 2025, and the 30-year climbed to 4.95%. Goldman Sachs warned clients that bonds will not cushion a deeper equity decline because inflation expectations are rising alongside geopolitical risk. CEPR research spanning 300 years of war-era bond performance found that bondholders suffered average real losses of 14% in the first 4 years of conflicts, and cumulative returns ran more than 20% below equities. Fed Vice Chair Bowman still penciled in 3 cuts before year-end, but CME FedWatch now shows a 40% chance of at least 1 rate hike by October, and Polymarket's hike probability has jumped from 6% to 24% since the war started. Morningstar's chief U.S. strategist put it starkly: the Fed is now in a position where it can reasonably neither cut nor hike without risk. While broad equities fell, one group of stocks moved sharply in the opposite direction.